Muted.
Hello and welcome to today's First Property Group PLC preliminary results call. Throughout this call, all participants will be in listen-only mode, and afterwards there'll be a question and answer session. And just to remind you, this call is being recorded. Today I'm very pleased to pass you over to Jeremy Barks. Jeremy, please begin.
Good morning. Actually, I'm going to pass it to Ben Habib, who is the Chief Executive, who is here with George Digby, the Group Finance Director. I am the Marketing Director.
Well, good morning, everyone. Thank you very much for listening in and attending the results for First Property Group for the year to 31st March 2014. I'm going to dive straight into the presentation, which I think you've all got access to, and I'm going to start on page 5 on the presumption that you know, if you're on the call, what it is our business model is. Looking, therefore, at financial highlights, as is immediately evident, it's been a fantastic year for the group. Profit before tax was 6.57 million versus 3.5 million the year before. Diluted earnings per share was 100% up at 4.53 pence versus 2.18 pence the previous year. The result, which we'll come to in due course, but the result is principally due to two significant profits we made during the year on the purchase and subsequent sale of office blocks in Woking and Bracknell, which we acquired for an aggregate price of about 3.4 million and sold for a gross price of 8 million, having spent very little on them during the course of our ownership. On the back of that, on the back of our increased profits, we've increased the final dividend, which means that for the total year we would have paid a dividend of 1.12 pence per share, which is 4% up. That isn't as high an increase, obviously, as the profit has been, and the reason for that is we regard the profits made on the Woking and Bracknell deals as one-off, so the sustainable underlying revenue of the group is obviously not doubled, and one has to keep an eye on sustainable earning streams when determining ongoing dividend policy. And also, as shareholders will be aware, we have the maturity of our largest fund in August 2015, and until matters with respect to that fund are resolved, we feel it sensible to be prudent on dividend increases. Moving down the page, fund management income was down slightly as a result of assets under management being down slightly. Profits made from group properties, which includes the two office deals that I've just mentioned, obviously up substantially. We had a peculiar set of FX rates during the year, so the average FX rate during the year benefited us to the tune of around 3.1%, but we ended the period on a weaker exchange rate than we started the year, and it would appear that for the year to 31st March 2015, if all things remain as they are at the moment, we're going to have a slight FX headwind. Shareholders may recall that we earn most of our fund management income and a large proportion of our investment income on properties that we ourselves own in euros. So as the euro weakens, obviously our profits in sterling terms are adversely affected. Net assets were up 27% in line with our increased profits, and just to remind shareholders that to the extent that the group has property interests, we hold them at the lower of cost or market value. So all the increase in net assets is from accrued earnings. It's not from revaluing assets. So it's sort of real net assets, if you're with me. Cash balances were down slightly, notwithstanding our very significant cash generation, and that was because we made around £7.5 million worth of investments on behalf of the group during the course of the year. So cash would have been materially higher had we not made those investments. And as I mentioned earlier, assets under management were slightly down during the course of the year. Turning over to page 6, I think I've hit a lot of the points here already, but just to summarize, operational highlights, big profits on the two office deals which we bought for 3.4 million and sold for 8 generating a contribution to earnings after costs of around 3.8 million. We have set up a new fund called Fprop PDR. The PDR stands for Permitted Development Rights, and Fprop PDR raised £41 million in October 2013 with the aim of buying more of these vacant or short-let office blocks with a view to gaining planning permission pursuant to permitted development rights to convert them to residential use and then, make gains on the sale of the properties. So far, we've invested just over half of the £41 million in the fund, on which we would expect to earn development profits during this and next year. It's hard to quantify exactly what those development profits will be, but we're fairly confident that we will make some reasonable profits. And just to remind shareholders again, on Fprop PDR, we don't charge the fund and our investors a fee. We take 20% of the profits that fund makes. So it's a profit share that we have. FOP, which stands for Fprop Opportunities PLC, and which is our sort of core fund for investment in Poland, made 2 investments during the year for a total value of around 35 million euros, one of which was a shopping centre in Ostrowiec, eastern Poland, and the other an office block in a city called Lublin. Those acquisitions were made in February and November, respectively, so they made very little contribution for the year to 31st March 2014, and we expect a full year's contribution, obviously, during the year to 31st March 2015, and we would expect FOP to make further investments during the course of this year. As I mentioned, our cash balances were down slightly as a result of the £7.5 million that we've invested in the deals that FOP did. And remember that we consolidate the results of FOP because the group owns 76% of it. We also bought more of Blue Tower. We used to own 28% of Blue Tower. We now own just over 48%. This is a secondary office block in a prime location in Warsaw. And we've invested some cash in Fprop PDR as well. So the total investments made by the group during the year were £7.5 million. And though this is a measure of our historic performance rather than anything that we might achieve in the future, we have been rated again by IPD as the best performing fund manager in Central and Eastern Europe for the 8 years to 31st December 2013, having been the best performing fund manager over the shorter periods for 7, 6, 5 and 4 years and 3 years for the preceding periods. Turning to page 7, which provides a graph of our dividend history. I know I said this last time we met to discuss our results, that we're very proud of the fact that during the course of the credit crunch, we have, as a group, not had to raise a single penny of new capital to sustain our balance sheet. Moreover, we have paid an increasing dividend stream to our shareholders throughout, and there can't be many property companies or fund managers that can boast that set of results. And before I leave the dividend page, I ought to just say and remind shareholders again that we have a very progressive attitude to dividends. As our sustainable earnings rise, it is our intention to increase our dividend payout. We haven't increased it as much as our profits this year because the bulk of our increase in profits come from non-recurring items as opposed to recurring items. So it's the sustainable profits that we look at when we determine our dividend policy. Turning over to page 9, which is really a restatement in numerical terms of some of the points I've already made. Fund management income slightly down during the year, but group property profits obviously substantially up. Page 10 provides you with a synopsis of the various funds that we manage. Regional property trading and Fifth Property Trading are legacy funds, if you like. They go back to the early years of our fund management activities. Shareholders in those funds are very happy. They've had all their capital back and continue to receive dividends. Those funds have maturity dates of August 2015 and December 2014, and we expect to extend those fund expiry dates by 3 years to August 2018 and December 2017 in the near future. The USS Fprop Managed Property Portfolio Fund, which is our largest fund, expires in August 2015. We do not expect that fund to be renewed, and we are going through a disposal process of some of those assets at the moment, and obviously that is an important fund for the group, and the resolution of that fund is a key determinant in guiding our dividend policy, which I mentioned earlier. And so until we've really got the USS fund in focus, we're going to take a cautious attitude to the dividend. UK PPP is a fund that we set up in the nadir of the credit crunch, and it bought what we regard as recession-resilient property on an ungeared basis on behalf of 3 pension funds in the United Kingdom who are advised by Stanford Associates. That fund has about £90 million worth of property in it. It's got an occupancy ratio of about 99.5%. It always has had. It throws off a net return of around 6.5% per annum to its shareholders, who are, I think I'm right in saying, very happy with its performance. Fprop Opportunities PLC, which accounts for 20% of assets under management, is 76% owned by the group, and our focus for Poland is very much going to be through FOP. We consolidate the results of FOP, the only fund whose results we consolidate, so it's sort of on its own, as it were, in that accounting treatment, but it's a core part of the group's future and one on which we obviously focus quite hard. Fprop PDR is the fund I mentioned that we raised in October 2013. That has a short life, and the reason it has a short life is that the permitted development rights, which it is using to determine its investment targets, the permitted development rights are only for a limited period until 30th May 2016. So it needs to have invested all its cash really by the end of this year, giving it enough time to gain the permitted development rights on the investments it makes and then implement them prior to May 2016. It can go on building out after May 2016, but it needs to have implemented the planning permissions by then. We expect that fund to do very well on the back of the buoyant residential market and the Help to Buy scheme, and it may interest shareholders who are not aware that the Help to Buy scheme, which has 2 legs to it, one that supports the construction of new homes and is a smaller scheme and provides 20% equity loans to buyers of residential property, has been extended from its original date, which also was May 2016, to 2020, and that's very helpful for our endeavours with Fprop PDR because it is buying the kind of property that will suit the new build Help to Buy scheme. The other leg of Help to Buy, which is for existing residential property, so not new build, and that provides a mortgage guarantee by the government. That expires in May 2016. We're less reliant on that, but of course that does help buoy the residential market generally. So those are our funds under management. I don't intend going through page 11, which is just a breakdown of our various funds by type of investor and geography. Page 12 deals in slightly greater detail with how the group's properties are made up. So as I mentioned, we own our principal sort of ongoing asset is Blue Tower in Warsaw's Central Business District. We own 48.2% of the tower. For any people who are nervous of the fact that we don't have a controlling interest in one of our major assets, you should note that we own 90% of the management company which manages Blue Tower. So we actually have control of the destiny of the tower, even though we don't have an economic interest in it that exceeds 48%. And in some respects, that's almost better than having total ownership of the tower because we have control of it without a full economic interest. However, if other parts of the tower come up for sale and the price is right, we will be looking to increase our shareholding in the tower. As mentioned now on a couple of occasions, we bought 2 office blocks in Woking and Bracknell, which we've now sold at significant profit. We also have co-investments in 5 of the 7 funds that we manage, and a breakdown of that is given on the following page, which I'm going to turn to now. And you can see that our biggest interest is Fprop Opportunities PLC, which I mentioned we consolidate, and then we have lesser interest in the others. Our shareholdings in Fifth and Regional Property Trading oscillate a bit. The group may, from time to time, act as a maker of markets and shares in those, an informal maker of markets of shares in those funds. So if we have an incumbent shareholder in one of those funds who wants to sell, the group may step in and buy them out. So we try to sort of match up demand with seller interest as and when we become aware of it. Our shareholding has, however, been quite stable in those 2 funds. I think the figures on that page are self-explanatory, so I don't intend going through them. And page 14 gives a breakdown in monetary terms of where we get our earnings. The direct properties very substantially up from 2013 as a result of the Woking and Bracknell deals, and Fprop obviously increasing its percentage contribution to the group as it invests its capital. Turning to Outlook and moving to page 16, the immediate outlook for the group is obviously the prospect for immediate increases in profit for the group are perhaps most likely to come from Fprop PDR, where we now own £22 million of office block across the mostly southern part of the United Kingdom, and to the extent that we sell those at profit during the year to 31st March 2015, we will obviously boost our own profits by 20% of whatever those profits are. But they'll be one-off profits. They'll be nice to have and they'll boost our cash resources, but they'll be one-off profits. The medium to long-term important sort of future, if you like, of First Property Group really turns, in my view, on our fundraising capability for new funds and our investment of the cash that we already have in Fprop. And Fprop takes a very judicious approach, as you would expect it to its investments, which are long-term. And in Poland, which is an illiquid market, so it has to be very careful about the way it invests its capital, and it has to be confident that the total returns that it forecasts are genuinely going to be made. So it steps, if you like, more slowly and carefully. But we think that as and when it does make an investment or an acquisition, it should prove to be a very good one for the group. And I think the 2 investments it made last year, the office block in Lublin and the shopping centre in Ostrowiec, should over time prove to be very good investments for the group, for Fprop and therefore for the group. Turning to the market in which we operate, Poland has never gone into recession, which is something I've said since the credit crunch kicked off, which I've said, all these meetings. But it had nevertheless slowed down during the course of the credit crunch. Its worst period was probably 2011 and early 2012. It's a lot better off now. The world seems to be recovering, though there are signs of a general slowdown again in certain markets. But essentially the story for Poland right now is increasing consumer spending, increasing employment, increasing exports. And so the picture is pretty rosy for Poland right now. And from a property man's perspective, that's obviously very helpful. Consumer spending in particular is very helpful for us, having bought this shopping centre in Ostrowiec. To the extent that there are clouds on the horizon, I think they come from 2 general directions for Poland. The first is what's happening in Ukraine, which is obviously unpredictable to some extent. But Poland relies on Ukraine and Russia for about 4% of its exports, so it's not going to be directly adversely affected by sanctions or anything like that. to any material extent. It relies on Ukraine. It relies on Russia via Ukraine for a proportion of its gas supplies. 60% of Polish gas imported was from Russia in 2013. And so if the tap to the Ukrainian pipe gets turned off, obviously that would have an immediate impact on the Polish economy. And we sort of watch that space. But actually we're not overly worried ourselves about the impact of what's happening in Ukraine on Poland. The other sort of cloud that's hanging out there, I think, is one of general world slowdown. The European Union hasn't really emerged properly and robustly from the credit crunch in perhaps the same way as the United Kingdom and the US appear to be emerging. And there seems to be some talk of a slowdown in Asia, and that's important for German exports. And if German exports slow down, then Polish exports slow down. And Germany is much more important to Poland than the Ukraine is. So we're sort of watching that. But we expect GDP growth this year to be healthy. We expect consumer spending to be good. As I mentioned, unemployment is dropping. It's fiscally very sound. Poland government debt is at a very manageable level of around 50% of GDP. It's got a strengthening currency. As the euro weakens against sterling, the Polish zloty, which floats, is actually strengthened against euro. I imagine the Polish authorities will want to keep a lid on the strengthening zloty, so I don't think they'll be cutting interest rates, but they may be selling zlotys and buying euros, and so they should see increased foreign currency reserves, and a strengthening zloty is obviously very good for their fiscal state. So we see Poland's broad economy as very helpful to our endeavours. There are some issues in the property market which we need to be aware of. I've mentioned one of them, which is the illiquidity of Polish property, particularly the kind of property that we like buying, which is good secondary assets. Most of Polish property turnover is determined by international investors. So it's something like 90-odd% of the Polish turnover last year was from international investors. They target prime property, they don't target secondary property, and so you have to be particularly Kiwi when you're buying secondary property. You have to have an eye on how your returns are going to be made up, and given that exit prices are imponderable, you have to be much more certain of the income return that you're going to get, and you need to be prepared to sit it out until capital values recover, if necessary, before you sell. That means you have to buy judiciously. It's a statement of the obvious, perhaps, but it's worth bringing it to your attention. The other thing that I think needs to be borne in mind is that because Poland hasn't gone into credit crunch, into recession, and their banks haven't suffered in the way that our banks suffered in the West, they have had continued building of new offices, particularly in Warsaw, periphery Warsaw, and to a lesser extent in the central business district, and that has created an increase in the void space. I think the void space in Warsaw now is around 10%, and it used to be around 6%. And that clearly needs to be monitored because that has a downward bearing on rents. We're pretty confident with Blue Tower that it's fine because the rents in the building are very low and it's in a very prime position. So we're confident of the rental levels and the sustainability of that income. But, in our investment decisions, we have to obviously have an eye on the supply of new offices coming on in Warsaw. And also, irrespective of what other commentators might say, we think that broadly there's been too much development of retail property around Poland. There are smaller conurbations which have been overlooked where perhaps more development could take place, but the flip side of that coin is that they're smaller conurbations, therefore they're smaller developments, and therefore they're more vulnerable to new developments being undertaken, and also their pricing and their liquidity becomes questionable because of their secondary nature. So, the landscape on the property side has a few issues with it that one has to be aware of when investing. But broadly, the economy is good, and tenant demand for property broadly is good, and we expect income levels to be broadly, therefore, sustainable. Turning over to page 18 and looking at the UK, we've had a marked turnaround in the UK economy in the last 12 months as well as the property market. So we've gone from a really very weak economy, overburdened by debt, to actually suddenly being a sort of beacon of growth in Europe. My own view, for what it's worth, is a lot of that is driven by a resurgence of the housing market and government policy associated with the housing market. And we'll just see how that plays out post-election. But certainly at the moment we seem to be doing very well as an economy. Turnover in the property market was up substantially last year. During the credit crunch years, it was down at about 30 billion, 35 billion a year, up to 53 billion. Investors are now going broader afield. They're looking outside prime property. They're looking at secondary property as well. And we've seen some benefit to the UKPP fund that we manage, with property values beginning to rise in that fund as well, having been fairly stagnant to sliding slightly over the last couple of years. So we would expect some capital gains in our UKPP fund coming from the resurgence of buyer interest in secondary property in the UK. So as it happens, the two geographies in which we invest in Europe, Poland and United Kingdom, are arguably the two best performing, or one of the two best performing geographies in Europe. I've really, I think, done page 19 through my earlier comments, and I don't intend, therefore, to repeat myself. And that brings me to an end of the formal bit of our presentation. There are some more statistics and information on pages 22 through to the end of our presentation, which obviously you can look at your leisure. But I think I'll now hand over to questions. And just to remind you, I'm joined in the room by George Digby, our Finance Director. So if there are any particularly demanding questions on the finances, George is here to answer them. So having said that, thank you very much, everyone, and I'll hand over to questions now.
Thank you. Ladies and gentlemen, if you wish to ask a question, could you please press 0 and then 1 on your phone keypad now in order to enter the queue, and then after you're announced, just ask your question. And if you find that question has been answered before it's your turn to speak, simply press 0 and then 2 to cancel. And there'll be a brief pause while questions are being registered.
Any questions in the room?
One small one. How big were these two office blocks in Woking and Bracknell in terms of how many flats they'd be converted into? I'm
getting my memory, but I think the Woking property was 5 or 6 blocks of offices with a total area. If you give me 2 seconds, I'll give you a much more accurate figure. Total area, it was about 50,000 square feet, but can you give me 2 seconds? Yeah, about 50,000 square feet, and Bracknell was about 21,000 square feet. So we bought them at around £50 a square foot, and we got planning permission through the permitted development rights route, and then sold them we sold the Woking one at £120 a square foot, having bought it for around 50, and Bracknell we sold for about £100 a square foot. That's a very sweet deal, and it's not going to be, those kind of figures are not going to be repeatable in the Fprop PDR fund, because we were very early off into the buying office blocks when PDR was first mooted by the government, and in those days even some of the listed residential property developers weren't aware of PDR. But now every set of property particulars marketing an office block mentions PDR, so that the opportunity for buying stuff at those levels is gone. But we do see good profits nevertheless coming out of Fprop PDR.
So Woking flats will be quite expensive flats.
Woking flats exit at about £350 a square foot, something like that, roughly.
We're talking about £300,000 for flats.
Yeah, probably slightly less, because flats will be about 700, two-bedroom flats, 700 square feet, So 250,000 a flat. And that's in the Help to Buy sweet spot. The Help to Buy caps out at 600,000, as you probably know. So, we're selling into the market that benefits from Help to Buy. Any other questions in the room? Any questions on the phone?
There are currently no questions on the phone.
How many? You say you've invested more than half the funds for PDR. How many more blocks is that?
We bought 7 blocks, and we got one under offer at 8 million. So we've invested 22 million. We've got one under offer at 8 million, which would take us up to 30.
And you bought two blocks from USS in Poland. How many more investments have they got in Poland?
They have another 16 properties in Poland, roughly. I think that's right.
Yes.
And obviously, we're a natural buyer of those properties, but we have got an inherent conflict of interest, so we do have to manage that process very carefully.
I noticed you carefully bought them at fair value, but presumably you don't have enough funds to buy the lot.
We may or may not have enough funds to buy the lot. It just depends on the selling price. But we obviously believe in the properties that are in the USS fund because we bought them for the USS fund. The properties in it are not without their issues, having been bought in the boom of time, as it were, and there are management issues with some of the properties. But at the right price, I think we would be a natural buyer, subject obviously to carefully managing any conflict of interest.
Technical question, but I'll ask George after.
Okay. Well, if there are no questions on the phone, I think we can bring the meeting to a close. Last opportunity, therefore, for anyone on the telephone who wants to ask a question.
Once again, if you're on the phones and you wish to ask a question, please could you press 0 and then 1 on your phone keypad now. Gentlemen, at this stage, there are no questions.
Okay, well, thank you very much, everyone, and I think we can call the meeting to a close then. Thank you very much.
This now concludes the call. Thank you all very much for attending. You may now disconnect your line.